Hello everyone, today we will be talking about the performance of the agrochemical industry. The overall performance of the industry in the latest quarter remained a mixed one. While there were a few companies which have started showing green shoots and are reporting an improving performance, there were many others which are still impacted by high raw material costs. So just talking about the industry trends, overall there was a weak domestic performance. The current Rabi season has been weak for the companies. The northeast monsoon has been a deficit one, because of which the acreages were down and there was a low soil moisture content level. This impacts the volumes adversely. Moreover, because of sale of the crops below MSP in the preceding Kharif season, the position of the farmers was a little cash stressed, and this again impacted the overall sales for the companies in the domestic markets. So overall we saw that the companies which have major exposure in the domestic markets were impacted more, and the ones which have exposure to exports actually performed better. The second point was that there are high raw material costs and the margins of the companies continue to be impacted. The China supply situation is still stressed. Although there are new sources of supply coming up worldwide, the raw material cost was one major factor which ate away the profitability of the companies. Most managements, however, are now indicating that the position is stabilizing a bit, and the prices are cooling off and there might not be further uptick. So there might be a relief in margins in the coming quarters. Because of this situation, a lot of companies are also getting into backward integration so that they can ensure a smooth supply of raw materials as well as ensure a cost stability for their inputs. This backward integration will ensure that there is an adequate supply in the market in the future. Most companies are also focusing on new product launches. There was a ban on 20 chemicals in 2018, because of which there was an expectation that the volumes will go down. However, most companies are now working on greener chemistries, and they are planning to launch a lot of products in 2019. The products which have already been launched are also getting a good response in the market. So this will improve the overall volumes and will help to make up for the lost volumes from the banning of the products. Now talking about the stocks which we like from the sector, we'll pick up two stocks. First is PI Industries and the second one is Insecticides India. Well, why PI Industries? The company has a very strong order book and has a healthy pipeline of new products. So we expect that the current growth, the current good performance will continue in the coming quarters. The company also has a good high returns. ROC is almost 25%, so a healthy ROC. The company has a debt-free balance sheet, so this leaves scope for expansion in the future and also investment in research and development, which would be a positive for the growth in the future. Overall, we would say that the stock has moved up a little bit. There is very limited upside, but then it is a growing and a quality stock, and we would recommend to keep on your radar. And whenever there is a good buying opportunity, investors can look into investing into PI Industries. The second stock on our radar is Insecticides India, again a growing stock. There were a lot of concerns because three of the products of this company fall under the list of the banned chemicals. However, the company is now investing into new products. It has a healthy pipeline which it is already launching and will be launching in 2019. So this will make up for the lost volumes. The company is also investing in backward integration, which will ensure that there is an availability of raw materials at stable costs. So this will be a healthy sign for the margins of the company. The management is strategically moving towards branded higher margin products, so the product mix is improving. This is again a healthy sign for the margins, and it is also focusing on export expansion, again a very positive for the growth of the company. The stock is currently trading at a 11x 2020 PE, so we find this as a nice growing stock and can be looked if you want to invest in the agrochemical space. Well, this will be all from the agrochemical space at the moment. If you want to read a little more about our research, please log on to moneycontrol.com.